All right. Here's the deal. So I'm a CPA. I started off on the audit side. So I worked at EY originally, focused on the audit, and then went into merger and acquisitions and yellow book audit, all horrible, and I hated it. And it wasn't for me, but coming out of college, it was a good position. I stayed with it. My buddy, who's now my partner, Jason Kirks, anyone who's worked with us in the fixed asset, which is what we call our real estate division, he heads it up. He's fantastic. I actually worked for him. He got me my job at EY, but we did grow up in middle school together, so we're two buddies that run this firm. Originally, we had gone in as CFOs. So when I left public accounting, I wanted to be a CFO, and I had all of these great relationships, and one of the first, about a year and a half in, we started running into folks that were looking to raise capital, right? And we said, great, we know how to do that. And we were trying to get these companies what's called comparative GAAP financial ready. Has anyone heard of GAAP?
Generally accepted practices?
That's so close, I'm going to call it 100. Yeah, generally accepted accounting principles. So this whole world, right? And basically, if you're going to be taken seriously and raise money, you have to be speaking the language. In CFO or whatever position coming in, they want to see a certain level of elevated understanding of the financials. We went into a company that was doing very well, lots of cash on hand, looking to see what it would look like to raise about 30 million. We specialized in about 50 to 50. Top line was our wheelhouse. And the owner came up and said, hey, I'm considering an offer, and I don't know how much of my equity and all the rest of this stuff. And he said, but I really would like to get about $30 million to be able to continue to scale the business. And I'm thinking of bringing an equity partner in. And this guy's crazy. He's a good friend of mine now. So I can say that on record. He drives for Porsche. I mean, these are substance abuse rehabs. He has quite a few extremely nice facilities and 30-day and all the rest of this stuff. So he owned a lot of real estate. That's where this story is going, right? And so we started taking a look through his portfolio. All this time, my wife, who still works at PwC, she is climbing through the ranks at their specialized tax services. And if you look at our website and everything else, we do brand as a specialized tax services firm. So this is what I've shifted into. Basically, I said, hey, her name's Heidi. Heidi, we've got a pretty big fish here looking to move some stuff around. Is there anything we can do before he raises capital? He really is not the type of person who plays well with others. He's creative, put it like that. Whatever he wants to do today might be different tomorrow. We didn't see it going well having other people, especially institutional level partners, come in. And he's a friend, so we were trying to figure out some creative alternatives. We went through and got about $22 million retroactive from his missed taxes, and a star was born. That's how this all comes to be realistic for me, is that we are coming from a position where we think that people are taking their real estate tax breaks, and people are taking their research development or taking their transfer pricing and all of the rest of these procedures that we assume CPAs and CFOs know and are doing. Because in the Fortune 500, it's policy and procedure. This is what they do, right? There's a playbook. So a lot of times people are like, oh, you're so smart, you're so creative. I'm like, didn't create any of it, totally rinse and repeat. This is well-established stuff. Yes, land easements, and there's things that are on the fringe that we don't touch. But anything that we talk about is going to be the playbook. And today, what I'm going to talk to you guys about is inside the real estate space, what that looks like. Cool. There's my backdrop. Okay. Next thing, real estate is going through some changes, which we'll touch first. And then I was talking with a few of you tonight already. Who has heard of the Big Beautiful Bill? Who has not heard? Yeah. So what a name. The Big Beautiful Bill is currently, the version from the House is released about 12 days ago. Now it's on to the Senate. They're making their changes. Soon they're going to reconcile. There's a push to have it on the president's desk by July 4th. They go on recess this Friday. If anyone reads the Wall Street, one of the biggest things in there today was that the president basically told the Congress that they can't have a vacation, which is funny. He's dictating the PTO for these gentlemen, ladies and gentlemen, and I thought that was hilarious. But basically, there's a huge bill that's trying to be what I would consider accelerated through with a lot of ramifications. There's a lot of cool stuff in there. If you're wanting to get into any of it, our job as an STS firm, Specialized Tax Service, we're about 50-50 lawyers and CPAs. I'm on the CPA side. So I have my CPA, Jason's a CPA, but we interface with lawyers, and what an STS should do is sit as close to law as possible so that if your accountant or CPA is confused for the first 5 years, they copy our work. Someone has to be the first one to say, this is how we're going to implement it. And we copy the Big Four. So everybody's just hoping the smartest guy somewhere is going to do it, and the IRS will agree with our positions. But for the big, beautiful bill, there's a lot of things moving with SALT, TIP, the state and local tax, the TIPS credit. The big ones that we're going to talk about, by the way, amortization. Does anyone know what the research credit or R&D? Anyone work anywhere we take an R&D? They made you amortize expenses, and they're going to be removing those, but there's no language stating that you don't have to unamortize them, so you're going to have this weird 5-year amortization period. All sorts of fun stuff if you're into that. The biggest thing that we're going to talk about tonight, and then get into kind of what that means, is that bonus depreciation, which is sunsetting, will be making a 100% comeback, which puts us, as a firm that knows what that means, it's the most important thing that's going on for us and our clients. So who has heard of bonus depreciation? The truth is that a lot of people, including CPAs, are confused about what depreciation is and how it works with real estate, and they're really confused about bonus depreciation, and then most can't effectively consult on the most advantageous ways to go about it. So you got these tiers of understanding. Bonus depreciation, let's get into it. Bonus depreciation, when I say depreciation, take expense. And I think for today, this is a reading the room, we're going to start with how are you taxed? And the reason why is because I think that without understanding kind of this opening dialogue or a refresher, maybe a polite word for it, you may be lost as we move along. So let's just say that you make $1 million a year, and your expenses are $500,000. We've got a net income of $500,000, and that gets passed into the tax bracket. Okay? And at the top, right now it's around $750, it's 37%. In our world, because if you don't make good money, you're not going to hire top talent to make it so that you pay less tax. We almost always refer to everything as 37. But when I say 37, take your own bracket, okay? A second thing, we don't incorporate state. I'm in New York, it's great, just go with the flow here, go with the program. The 37 is, when I say 37 throughout the night, I'm referring to your tax bracket, because when you get a deduction, it sits here, it's called above the line. And so if I give you a $300,000 deduction, you don't pay $300,000 less of tax because it's an expense, right? So it's going to boost this, and then your net income is going to go down to $200,000. So that's another misconception we get sometimes. People will look into getting write-offs. This goes for all write-offs. If anyone doesn't get exactly what a write-off is. A write-off means if I'm in the 37% bracket and I buy something for $1, effectively I've paid, and it's a business expense, I've paid $1 minus 37 because I got to write it off, and my current tax bracket is 37. Which becomes very powerful. We're moving to real estate. Let's pretend I'm making an investment decision. I want to put a $100,000 pool into the back because I think that it's going to raise the rent. If I'm in the highest tax bracket and I buy a $100,000 pool, I got $37,000 off in the sense that I would have paid tax. So the write-off all happens in this bucket, the expense bucket, okay? And when I say depreciation, even though it's not accurate, and amortization, and there's a lot of vocab, basically you can just say, okay, it's an expense. And it's going to net against my revenue. And do we want to have any net income for the year? No, because once this hits zero, you're taxed on nothing, which means you'll pay nothing. And real estate has a ton of very favorable laws. One of the items about depreciation, as long as you hold the asset, it's on your balance sheet, the deductions carry forward. So if I get a $5 million write-off in real estate, I won't pay a dime of income tax until I make $5 million. And we have clients in real estate that have 5 or 10 or 15 years of operating that'll be tax-free. And that's how, we make our money. They hand them that. Okay. Any questions on that? Because if you've got a question on that, ask it now before we dive into what is fixed asset management and cost seg and tangible property regulations and all the rest of this stuff. Great question. Yeah, recapture, we'll hit that tonight. I love that one. Recapture. Reno is my favorite topic. We'll get into reno. Good. Oh yeah, I love that. We'll get 3115 discussion. That's a short one. I'll probably start with that. I love that question. All right. Yeah, I like it though. We'll go 1031s. Awesome. Let me start with a quick overview of what is cost segregation studies. These are, I would say, trending, not trendy. They've always been in fashion. They're trending, okay? And you've probably heard of them. Oftentimes, different influencers and stuff like that are catching on that there's a huge write-off, and so they'll use it, but there's not a lot of material on exactly how they work. And the problem is cost seg works differently for basically every example. All right, overview of cost seg. I'm going to make this as blanket statement and as easy as I can. We'll use this property, okay? Purchase price, $630, so $630,000. I come in as an investor and I spend $630,000 on this. Who here has heard of a balance sheet? Let's see some hands, because I'm not going to waste anyone's time if we don't have a lot of hands, which we don't. Okay, a balance sheet basically is just a way we accounting folks do all of our double entry accounting, okay? And what it means is assets equals liability plus owner's equity. And these two sides will always balance a balance sheet. You guys are probably more familiar with the P&L. They are those are the cornerstone of understanding and operating a business. And a balance sheet will show us what you currently own. It's very helpful. Versus what you own, your assets, only versus the liability. So if I own $1 million property, but I owe 800, I'm really worth, and that is probably sitting where? In my owner's equity, right? So pretty simple concept, very challenging to book all the entries correctly. In real estate, almost all of your money is sitting over here on the asset side. As far as you're holding these pieces of real estate, and you can imagine it's going to be something called the fixed asset. And fixed means I can do this most of the time. Tangible, okay? And we call that your fixed asset ledger, that whole section. I won't say bad, but a lot of CPAs, depending especially on your market and some other stuff, a lot of CPAs will book the transaction like this. $1 million. We're going to go away because I can't do math. But we're going to pretend this house is, this is a gorgeous $1 million property. Okay. You've got $1 million, and it goes onto your balance sheet. The first thing most CPAs should do, and yes, if you want the easiest thing you can take away to vet your CPA, it'll be to check your balance sheet. And if they've got the full transaction and there's land, run. Because they're depreciating land. And we see that more than once a week. Okay, so $1 million, they should break it down and say, okay, the land value of this is, we'll call it 20%. So it'd be $200K, this is now gone, it'd be $800,000. And that goes onto your balance sheet. Land, this is an L, does not depreciate, and building does. And what is depreciation? Who here would want to take $800,000 write-off today? Time value of money dictates that I'd love to take my expenses now. The IRS, which this all makes sense, say you can't do that because it's got a useful life, right? And the useful life, like if a car's an easy one, $100,000 car, 5-year useful life, all of the assets are dictated by the IRS for what their useful life is. $100,000 car means you'll get $20,000 each year of a write-off. And a lot of people hopefully have experienced that, or if they own a business asset for a vehicle, they've seen it. A building has one of two useful lives. This one doesn't exist. These 27.5 and 39 are what the IRS gives us as a useful life. And if you own who owns real estate currently? Okay, if you look at your tax return on your depreciation schedule, you will see this, which is the whole world we're living in. We're drilling down like we're here now, okay? This is all talking about depreciation and how we accelerate it to the current year to take that 800,000 now, which again, spoiler, we'll never be able to take the whole write-off. But we're trying to get more of it this year than we do. Okay, so we'll say, is this gonna be a short-term rental or long-term? Short-term? Fun fact, short-term rentals, if rented less than 7 nights on average, are actually called transient property, which puts them over here. We see that wrong all the time. You would think residential, 27.5. Is a hotel a residential property? It's not. So one thing to take a look for is that you have your short-term rentals correctly being depreciated over here. Back to our example though, for the big overview. 800,000 of a building. Now, who here thinks that we paid 800,000 for just a building? Me neither. And so the argument is that while that's easy and you can book it, there's a lot of other stuff that exists for that purchase price. You've got the nice walkway. I'll sell it for you. The gorgeous front, the interior design, right? You've got these cabinets and the flooring and the fixtures, the light fixtures and the plumbing and the electrical and the finishes, right? Coming in here, we may be able to say that we've got, call it $100,000 of land improvements, aka landscaping, and we have 200,000 of interior, anything inside the walls. And so people start, you can start to see how this gets a little nuanced, right? What if it's a condo? Do I want land? Here's an easy question. Do you want land that's high or low? Why? Land takes right out of your basis and everything else we're trying to write off. So people will get a great cost seg and this other study's done and stuff, and they'll go for their second property and they'll say, Brian, I spent $1 million on this last one, you gave me a $300,000 write-off. I played around at Pebble Beach with that, man. What happened? I just got a second one, you gave me $150,000. You bought it on the beach. You paid $1 million, but $500,000 was for the land. Land doesn't depreciate. So like knowing each one of these layers makes a lot of money. Who here likes making money? Yeah, I got your attention. 200 interior. So now what we're looking at is $500,000 building. So remember, these are your useful lives. Okay, so what it looks like here is I've got my depreciable years. 5-year is going to be everything interior. Boop. So you got 200 right here. Then you got 100. Sorry, 7 is going to be like data centers and stuff. This really should be 15. There is a 7-year, but I normally skip it. For these conversations, it's definitely able to be breezed through. And then there's no 27 because we put this whole building into 39. So if I'm taking 200,000 over the next 5 years compared to over 39 years, is that awesome? Yes.
Take more upfront.
More upfront. More expenses netting your revenue up front means you have more cash flow now to leverage. Yeah, use in the way that you deem fit. Bonus depreciation dictates that I can take anything that's below, pretend there's a line right here at 20-year. Anything to the right is a long-term asset. It's actually a long life. And then anything below it is a short-lived asset. And there's some rules in the tax code that say anything that's less than 20 years is eligible for
Bonus depreciation.
and it's a percentage. It's very easy. This is like an easy step. Consider it a waterfall, right? So before you put any of this stuff into the depreciation schedule, they say, hey, want a kicker? And real estate, oil, like oil and gas, green energy. There's a lot of these like lines in there. Hey, you want a kicker? It's an incentive. And the incentive is to invest in real estate, right? Keep cities looking nice and invest in real estate. So bonus depreciation will dictate that of this $300,000, we can write off a percentage of it. before we get into any of the rest of that. Right now, it's a 40% year. So if you had $100,000, you'd get $40,000 now. The remaining 60 would sit inside the schedule, wherever it belongs, 5 or 15 year. At 100%, you would write off
40 in the first year.
all of it. All of it, right? And so the laws that are coming in, for those, again, guys, I know it's taxes. I get it. But the laws that are coming in are so freaking powerful. We're talking about being able to make hundreds of millions of dollars. Money that you would have spent on tax, and for anyone here who's a little bit more financially inclined, when you don't spend money, let's just take someone in New York, because again, easy math, and their taxes are huge, or California helps drive the point. You make $1 million. You live in New York. You owe $500,000, right? And we all know that if you invest, that's why they're like, invest when you're 10. Okay, I'll try. But you invest more now and it grows because it's exponential, right? And so if I'm going to make $1 million, imagine if you got to keep all $1 million. Next year, you make $1 million. You don't pay $500 again. After 2 years, you've now invested in one, $1 million, and the other one you've invested $2 million. Throw that into a calculator with your life insurance guy. You'll be hooked. Those are massive swings, right? And so these write-offs that can come from real estate, when you start to set yourself to net zero, net income, is extremely lucrative. And I put my money where my mouth is. I think that bringing back 100% bonus depreciation, I just went LOI on a $37 million property in Eugene, Oregon. Come check us out. You want to see me in 5 years, you're going to have to fly somewhere. Okay. Yeah, bonus depreciation is the real deal. If it comes back to 100, it's going to be really good stuff. And for folks who have positioned themselves well, such as real estate professionals who are already comfortable being like pretty exposed, right? When a client calls, we get a lot of doctors, lawyers saying, hey, we make a power couple. We're both doctors. We make $2 million. What do we do? We have to stick them into short-term rentals. And we can get into that because depreciation does not offset W-2 income. So if you're a really high earner W-2, you got to call me. There's a way that you can get over some of these hurdles. And basically, just to remove, there's no curtain, you have to buy short-term rentals. And you have to participate in them. Right? If you have rep status, a little different. But for today, we're going to go through the principles. But most of our clients are high earning W-2 as far as volume, and they're being pushed into short-term rentals. And for many of them, it's their first or second property ever. So if you're positioned in a place where you could be on the front end of that 100% bonus hitting the market, my oh my. All right. Okay. Here's the deal. Here's the kicker, because I used that term earlier. We'll do a callback. Bonus depreciation, all the rest of this stuff is all within real estate, and we know real estate is incentivized. Most of the time, there's a statute of limitation on how far back you can file. Also, most of the time, if you amend a return, you're inviting a discussion, right? Doesn't mean an audit. If you go back to the IRS and say, hey, you know what, I actually love to not pay that $300,000, they might say, who are you again? Would you like to pay zero income tax? Who here has been part of a 1031 transaction? Okay. 1031's great. And what we're talking about here is an entrance strategy versus an exit strategy. So when I buy a property, I want to take all of my deductions up front. And when I leave, I want to kick the can. They're two sides of the same coin. Basically, we won't get into it because 1031, you've got intermediaries and really useful folks. Basically, a 1031 says it's a like-kind exchange. If I'm going to sell this property and buy another one within a kind of tight timeline, I don't have to recognize a transaction. Basically, there's no taxable event. And so if there's no taxable event, I don't owe any taxes. Do 1031s take care of recapture? Yes, they do. I'll go on record, but it is complicated actually. But yes, and so we have seen a lot of 1031 people not fix, recapture, and carry it. So if you're owning real estate and you're going into a 1031 and you're worried about recapture, you need to either find a better 1031 guy or point them towards some code. 1031s absolutely take care of recapture, okay? There's ways that you have to go about it. The second thing, most real estate portfolios look like this over time, and this would be time, and my Y would be portfolio value, okay? Let's just pretend, to keep math nice and easy, that for every $1 million of real estate I purchase, I receive 20% as a deduction, which is a decent, it's a blanket, because they changed a lot, but it's a blanket statement that I think is fair. So at $1 million, I would get 200,000 of deductions. At 2 million, I would receive 400. Now I sell this. Say, let's pretend we have this already, and then 2 years later, we decide maybe we sell this and buy that, and we don't 1031, just to keep it really straightforward. I now have a $200,000 recapture and maybe $100,000 of capital gain, which means I'm still getting an extra $100,000 write-off. Cost seg dollars can be used against capital gains, recapture, which is just ordinary income. It's not as confusing. A lot of people get tripped up on recapture. As long as you continue to acquire more real estate, and you have to be smart enough, you can't sell a piece of real estate this year on like December. Because you see what I'm saying? You have to marry these two transactions in the same year, because you have recapture where your depreciation that you take goes away. So before 12/31, you need to buy that other property. In fact, that's called a lazy 1031. If you sell, let's say in January, you have all the way until December to buy that other one that'll offset all that. And a lot of companies acquire property in the last quarter, like big companies, strategically, because now they've got 3 quarters of operations, they know what they're looking at, and they're like, uh-oh, move that 26 purchase to October here, we're about to get hammered by taxes. Okay, 2 birds, 1 stone, 1031 recapture. Any questions on those? It's a paper loss. Let me explain how that looks real quick. So if we have $1 million property and it lasts for 39 years, every year we'll take about 20K, right? That's your write-off. At 39 years, is the $1 million property worth 0? No. What's up with that? Has the $1 million property potentially appreciated? Whoa. How many assets appreciate over 40 years? Not a lot of them. Y'all are a real estate room. The answer is most shit breaks over time. Okay? Cars, right? Think of computers as my favorite. Obsolete 2 years later, right? So as a business, if I buy a $1,000 laptop, do I want to write that thing off this year? Yes. Everyone wants to take the write-offs this year. Well, the IRS says, no, its useful life is longer than that. But you have to be able to write it off to 0 at some point. Those are the rules. That's how our accounting system works, is that you're able to take expenses. That's why land doesn't depreciate. A building will eventually fall down. When we're dead and gone, that dirt, as long as you're not like South Beach or something, that's a global warming joke. The dirt is going to be there. It's one of the only things, that doesn't depreciate. So when we're talking about paper losses, we're talking about the need to marry the fact that these things are depreciating, and eventually they will be rubble. Now, we know buildings you can fix and all sorts of stuff, which is leading me nicely into my reno. But does that kind of answer your question? So it's a paper loss because eventually you're going to write that thing down to 0. But when we take a $200,000 expense here, does the value of the building take a hit? No, not at all. That's why I absolutely love real estate. There's like certain cars and stuff. There's not a lot of assets that go up in value over time. Okay. A quick, easy one. Placed in service. So the question, I believe, from one of you gentlemen was, what happens if the laws change? Can you imagine? if every year you had to track the laws and understand how they're changing. So they said, obviously, real estate people are already not accountants and tax people, right? Certain industries have some leeway. They say, okay, in 2020, this was the law. The next year it might be totally different. If your property is placed in service this year, everything operates in this year. Makes it very clean cut, especially when not everything, but for the depreciation. You'll have a locked in bonus percentage. So, hey, what year did you buy it? 2020, great, 100% bonus. Because can you imagine if every year you had to then go in and do an 80% on that, then do a 60, you'd pay an accountant. That's definitely like my bookkeeping is no longer doable. So the place in service date is very important. So what does that mean as far as depreciation? We know it's locked in. What happens if I want to buy something on 12/31 of 2025? You find, I don't know, gold buried in your backyard or something. You got this huge gain you have to recognize. You're supposed to report it.
Oh, yeah.
I wouldn't. What happens if you have this $500,000 come in at the end of the year? And you're like, how do I fix it? If we stick within our vein of tonight's conversation, at 20%, we'll say we got to buy around 2.2 of real estate. You won't pay any tax on it. I'm buying it on Christmas Eve. Cool. Is that 2025? Yes. Right? So by making it simple, it also makes it pretty nice to be able to maneuver with tax planning for end of year. And almost all of our consulting in November and December is real estate. Because everything else is probably too late. But real estate has the place and service rules, which means place and service means that it's ready and available for use. So some clients will say, well, what happens if I didn't rent it? I listed it. It's like, could you have received any market value from it? Then yes. So it doesn't have to have a rental night or anything like that. All right, that one's easy. Who asked reno? You did. Who here is in the business of doing renovations? Is anyone like a builder? You are? Fair. No, I didn't start, so it was too daunting, and I sat at my desk like I do and went, this looks scary. Renovations. They're wildly lucrative. So I'm going to explain something. I had about a 2-hour call with a builder today on this. Renos are awesome. All right, you ready? Let's say we have $1 million of cash. Now, by the way, if you get the deductions or not is irrelevant to if you end up taking a loan, right? So like people sometimes will say, what percentage do I get if I put all cash in versus a loan? I'm like, the same exact deductions. You're in your balance sheet, like completely different. By the way, that's how those numbers get so wild. Your loan to value, you're basically leveraging deductions. Because if I buy $1 million property, I get my $200,000 deduction, but I only put 20% in. The deduction didn't change. You get a huge, massive write-offs with pretty small cash outlay. But let's focus. Fine, I will. $1 million. All right, we're going to do 2 examples here. Number 1 is just a turnkey purchase price allocation or cost seg, which is the proper term. If it's turnkey, you're going to be purchasing it. It's ready to roll as a purchase price allocation. $1 million, we expect to get $200,000. Everyone agree? That's your deduction, 20%, it's okay. Pretty straightforward. Let's say over here we buy a $500,000 property. We're gonna get $100,000 of deduction, the same 20%, and then someone who's brave and able to goes in and does $500,000 of CapEx or of renovations, okay? Question for my builder. What do you think this number is going to be?
600.
Whoa! Oh, this guy's, I need your accountant, bro. Cooking the books. I put 5 and I want 6 out. All right. How much you think?
5.
Why?
It's the 400 of renovations all together, plus 100.
This is your reno number. This is your building. He's not wrong. I'll say 5 would be an upper limit. That's the most. We normally see around, we'll call it 300. A healthy like 60%. And you might think, why is that? And if you start to understand everything we've discussed tonight, right? You've got your building, got your landscaping, and then you got your nice interior. We'll just say this bucket is all the interior stuff. When you do a renovation, are you putting it into the foundation, the concrete pours? Hopefully not, unless the foundation's messed up, but probably not. Are you like moving around? You may move some walls to change the landings and everything else, but for the most part, you're gonna spruce this up. That's a pool. Little people jumping around back there. You can put like a barbecue. You can build like $100,000 in the backyard. That'll boost the rent. Then you're gonna make a kitchen, really nice kitchen. Gut it. Some of our guts and our remodels will have 100% of the CapEx. Close. Will be first year write-off. So over here, we'll say that's 100 plus 3. That's $400,000 of deductions. Over here, I only got 2. Risk versus reward. A lot of folks who hear me speak are like, oh man, I'm gonna go do renovations. I'm like, I did not tell you to do that. But if you're already in the business of it, if you're comfortable, you've been in real estate for a long time, it can be super lucrative. A kicker, little caveat, little extra something for you. There's a strategy where if you straddle a year, so you're in year 0, and you come in, let's say you buy, and you rent it, you straddle into the next year, and then you start CapEx. And let's say you've got a $50,000 kitchen, and you put a $100,000 kitchen in. There's another study, not discussed very often, but worth everybody's hearing about at once, called a disposition, disposal of assets. Who's heard of a disposition study? No one, okay? Yeah, it's worth a lot of money for my builder friends. But all this stuff is so easy though. It makes perfect sense. Michael builds a house, buys a house. He builds it. You're gonna build it? I buy it. I come in 2 years later and I say, this is a gorgeous house. I'm gonna buy it. You say, great, $1 million. A year later, it's not getting the rent that I want. So you say, I'm gonna do a reno on it. I think the kitchen could be spruced up, especially 15 years ago, linoleum, right, or whatever, right? Eventually you wanna redo the kitchen. Is it fair to say that I paid $50,000 for Michael's original kitchen in the purchase price? Yeah, I spent $1 million and part of what he was charging me for was for the kitchen. Do I get to write off 50 plus 100 when I put my $100,000 kitchen in? Yeah, you bet. You bet, but there's some rules there. The best rule for this, if we're just doing a for fun evening, is a year and a day. It's the safest. So if I acquire a property and I run it for a year and 1 day, then make some business decisions, like that's a business decision. I want to switch the kitchen out. Nobody likes this kitchen, right? The kitchen sucks. Okay, I'm going to switch it out. Now, if you think about what we've built on the balance sheet, so remember that balance sheet? Remember this? That had the assets over here? When we come through and do a cost seg study, it looks like this. And that's 10 outlets. And this is like the roof and the supporting joints for the roof. Like everything should be broken down into the correct cost components at this point. Let's just take this bucket and say that's a $50K kitchen. That would be like your refrigerator and like the lower cabinets and stuff. So once we've identified what the kitchen's worth, when we gut it now, I can confidently, with a third-party approved kind of metric, pull the $50K out as an expense. Then we come in and we put a brand new $100,000 in here. So reno can get really lucrative on deductions. But I tell people, don't let the tax tail wag the dog. If you don't know what you're doing with renovations, maybe for the first 1 or 2, find someone who does great work and pay them and go through that whole learning experience, but reno is very lucrative. All right, what was your second question?
Can you roll forward the benefits?
Roll forward the benefits.
Let's say you don't use all your $400,000 expenses.
Yes, all of these, everything we're talking about, which is why I think the confusion existed. I use a term oftentimes called cost seg dollars. They're depreciation dollars. It's just a way to be like, these expenses exist. Deductions roll forward through time. until you sell the property or you use them. It's like a 20-year carry forward period, indefinite for some stuff. That's like as favorable as it gets. Anyone ever have an HSA or whatever, use it or lose it? Not that. It's got a very favorable treatment. And so if you imagine, guys, as you start to build and as you work with big clients, I don't know if you do like commercial loans or whatever, right? But you get $100 million property. We'll say we're sticking to our stuff. The ratios, by the way, once you learn what I've covered tonight, size doesn't matter, right, guys? Ratios stay the same. The ratios are almost always the same. Even on reno, you could do a reno of a huge skyscraper, we're expecting similar numbers, similar ratios. So on 100 million, 20 million, that means they're gonna make, call it 5 million a year. It would take them, and you can just add zeros, 50K, it's the same ratio. So the carry forward, and eventually what happens for a lot of folks who are in real estate and scale, a lot of them have carry forward deductions. I'm not gonna cover it tonight. Another fascinating piece, guess what you can eventually do with your deductions? Who said sell them? No, they have to be transferable credits to do that. You can build into the operating agreement, basically sell them. You can, with your partner, you can dictate how the depreciation is shared amongst a partnership. It's like you can dictate the share of the revenue, the split. It's all in there. So as long as there's certain criteria met, better example, real world. We say, hey man, let's go 50-50. I want to take down a $10 million property. You say, put it there, all right. Yeah. He spit on that thing. So if that's the deal we cut, all right, here's the thing. Let's say that I have already been stacking deductions and I don't need any more. I have $5 million of deductions waiting for me. And he's, man, I see what you're doing with these deductions. I need them, I don't have any. We can say, listen, why don't we go 70-30, where I'm gonna take 70% of the cash flow for the first 4.5 years. By the way, we can math this out. It just goes right into a very similar schedule until we break even. I'm gonna take 70-30 cash flow for the first couple years, and you can go 70-30 depreciation. So I can incentivize the deal and give him what he really wants. He's like, hey man, I make $1 million a year. I'm like, I'm poor. So you can play with these things, and we have seen people when they really want to partner with a group that use us as a company, and they're like, hey, we'd love to incentivize these guys. We'd be like, just give them the depreciation. And we have all seen like $300 million portfolio companies not doing this. And so our guys don't tell them until we cut the deal. And it's, hey, I'm gonna give you the $20 million write-off if we go into this deal together. Like, how? It's like, trade secrets. Let's do it though. I promise I'll deliver. And sure enough, so there's a negotiation factor eventually with these depreciable dollars. And they do, I use depreciation dollars because they do get traded at the highest level, they get traded around. Because if I just took down a huge property, do I need any more? No. And so I'm looking for someone who, I want cash now. I want cash flow.